Everybody knows the India growth story, right? It's been an absolute economic superstar. But what if I told you that behind the headlines, a lot of the big, smart money is actually quietly heading for the exits? In this explainer, we're going to dig into the hidden forces at play in the Indian stock market and find out why the next couple of years could be a really bumpy ride. And that really brings us to the core puzzle we need to solve. I mean, on the surface, everything looks incredible for India's long-term future. So why on earth are some of the world's biggest and savviest investors pulling their money out? It seems like it makes no sense at all. But as you'll see, there are some pretty powerful reasons why this is happening right now. Okay, so here's the main argument in a nutshell, and let me be super clear. Pretty much nobody is doubting India's long-term potential. That's not the debate. But the critical point for today is that the short term, the next 1 to 2 years, could be a really challenging sideways grind for the markets. And now we're going to break down exactly why that is. So, to really get what's happening, we have to put ourselves in the shoes of a foreign investor. For them, it's not just about picking a hot stock that's going to go up. It's about the cold, hard math of their final returns. And right now, that math just isn't adding up in India's favor. Now, this right here is probably the single biggest piece of the puzzle. What you're looking at isn't some sudden crash. It's a slow, steady bleed. For more than a decade, the Indian rupee has consistently lost value against the US dollar. And this one trend is the #1 headache for anyone investing from outside the country. And this slide just perfectly illustrates the simple but absolutely devastating math. So let's say you do great. You pick a stock and it pops 10%. Awesome. But during that same time, the rupee falls 8% against the dollar. So when you go to cash out and convert your rupees back to dollars, your real gain is a measly 2%. It's like trying to fill a bucket with a giant hole in it. Your profits are just leaking out through the currency exchange. And look, this isn't just a hypothetical problem. We're talking about a massive exodus of cash. In just 1 year, this number, 1.58 lakh crore, was pulled out by foreign institutional investors. To put that in perspective, that's about 19 billion US dollars, just yanked from the market. That is a huge vote of no confidence, all driven by that tough currency math we just saw. And here's the direct result of all that money flying out the door. This isn't just a tiny dip. We are seeing a major, fundamental shift. The amount of foreign ownership in the Indian market has been driven down to a level we haven't seen in 15 years. That's a serious trend. But wait, the story gets even more complicated. It's not just that India has some challenges. It's also that other parts of the world are becoming, well, irresistible. There's this giant global money magnet at work, and right now it's pulling a ton of capital away from emerging markets, including India. So think about it. If you're a global fund manager, you've got a choice to make. You can invest in India, which is a bet on broad, long-term economic growth, or you can go to the US and invest directly in the AI revolution. You can buy shares in companies like NVIDIA and Microsoft that are putting up mind-blowing numbers right now. The AI boom is happening in America, and that's where the global money is chasing the big, fast returns. This chart really puts it all into stark relief. Just look at this. Why would an investor take on all the risks of an emerging market just to get a potential 2% real return when they can just buy a US government bond, literally one of the safest assets on the entire planet, and get a guaranteed 4 to 5% return? For a lot of professional money managers, this has become a complete no-brainer. Okay, so we've got the currency problem and the huge pull from the US market. But there's a third layer to this story, this whole series of ongoing risks that just adds to what investors call the wall of worry. And a huge one for India is energy. The country imports about 85% of its crude oil. Now, what that means is that its economy is incredibly vulnerable to global price swings. Anytime there's geopolitical tension and oil prices spike, it hits India's economy hard, which fuels inflation and puts even more downward pressure on the rupee. And what we're all learning is that we don't live in a world of smooth, predictable cycles anymore. We live in an age of shocks. I mean, the last few years have just been a constant barrage of major geopolitical events that blow up existing trends and create enormous volatility. It makes long-term investing really, really tricky. And here's the real kicker. After all of that, after the currency drag, the competition from the US, the geopolitical risks, the Indian stock market is still expensive compared to its peers. So investors are being asked to pay a premium price for assets that come with a whole lot of extra risk. And right now, for many, that deal just doesn't make sense. So when you put all these pieces together, what does it all mean?
Well, it suggests we might be entering a new kind of normal for the markets, one that behaves very differently than what we've gotten used to over the last decade or so.
This quote from the analysis really just hits the nail on the head. So instead of those nice, strong, steady upward trends that you can ride for years, the market might just get stuck. It could be range bound, just bouncing up and down, and get shock driven, meaning it reacts violently to the next big global headline instead of following a clear path. All right, so let's boil it all down. Here are the key takeaways. First, the weak rupee is the silent profit killer for foreign investors. Second, the US market, with its AI boom and high risk-free interest rates, is just a way more attractive place to park cash right now. And third, all these constant geopolitical shocks are creating a volatile, unpredictable market where it's tough for any strong positive trend to really get going. And all of that leaves us with the big, fascinating question. There's no doubt that India's domestic economy is a powerhouse. You've got a rising middle class, huge local investment. It's an incredible story. But will that powerful internal engine be strong enough to fight against these very real, very strong global headwinds? Well, the next 1 to 2 years are going to give us the answer.